HMRC's new powers are causing a lot of worry, and understandably so. For years, most people believed HMRC only went after the ultra-rich, the sophisticated tax planners, the offshore billionaires. But that is no longer the case. What we are seeing now is a clear shift. HMRC's enforcement and technology are increasingly focused on the everyday business owner, the small side hustlers, the one-man band sole traders, the girl selling cupcakes on weekends, the Amazon and eBay resellers, the landlord with just one or two properties. These are now the individuals under the microscope. And when you combine HMRC's new digital powers, the expansion of making tax digital quarterly submissions, AI surveillance, and the revival of direct debt recovery, the direction becomes worryingly clear. So let us break down exactly what is happening and, more importantly, what you need to do to protect yourself. Making Tax Digital Expansion MTD ITSA 2026 to 28. HMRC is currently expanding Making Tax Digital for income tax. From 6th April 2026, all self-employed individuals and landlords earning over £50,000 will have to comply. The year after, the threshold drops to £30,000. Then from 2028, it is expected to apply from £20,000. So even if your business is just a side hustle, whether you are selling on eBay, doing dropshipping, or renting out one property, you will likely fall within MTD ITSA in the next few years. Quarterly reporting begins the biggest change. Goodbye to annual submissions. Under MTD, you must submit quarterly updates to HMRC every 3 months. In theory, it is about keeping digital records. In reality, the frequency increases the risk of missing deadlines, getting late filing points, interest on late tax, more compliance pressure. And although the government claims it is about simplifying tax, the practical effect is clear. More deadlines, more penalties, more revenue from fines. Direct recovery of debts. Another major concern. HMRC is moving ahead with direct recovery of debts, allowing them to directly take funds from your bank accounts without going to court. This power was proposed in 2015 but rejected. However, it has now entered a test and learn phase from late 2025. Here is what it means. If HMRC believes you owe tax over £1,000, they send notices. If you don't respond, they can instruct your bank to transfer money to HMRC. They must leave you with £5,000 minimum across your accounts. But everything above that can be taken. It is an enormous power for any government agency to have. HMRC's AI surveillance system, Connect. HMRC has one of the most advanced AI systems in Europe that is called Connect. While public services struggle, HMRC's digital system continue to expand. Connect can match and analyze your bank data, land registry records, social media activity, online marketplaces, Airbnb listings, holiday bookings, eBay and Amazon sales, property portals, lifestyle spending patterns, and so on and so forth. If your declared income doesn't align with your lifestyle, you may be flagged automatically. This is not targeted at billionaires. It is targeted at everyone. Even someone earning £15,000 to £20,000 a year who appears to be traveling frequently or posting luxury content online can be flagged by AI for an inquiry. Why cash is quietly being phased out? No, cash has not been banned, but many businesses have stopped accepting it, and the direction is clear. Digital payments create digital trails, and digital trails feed HMRC's Connect AI system. The less cash in circulation, the more transparency HMRC gains. HMRC's new informant incentive scheme. Another controversial move is HMRC's formal incentive program, where individuals can report others for unpaid tax and, depending on the case, receive a percentage of the tax recovered up to around 30%. In practice, this encourages people to report neighbors, colleagues, competitors, or even family members. Regardless of your views, it signals the direction of travel. More enforcement, more surveillance, more pressure on small earners. So, what should you do now? Don't stop your side hustle. Don't avoid becoming a landlord. Don't step away from being self employed. Instead, you must understand the rules, the deadlines, the digital systems, the allowable expenses, the legal tax saving strategies. There are HMRC approved ways to legally reduce your tax bill used by the wealthy for decades, and ordinary taxpayers can use them too. But guessing or hoping HMRC don't notice is no longer a safe strategy. Compliance is becoming strict. Digital monitoring is becoming smarter. Penalties are becoming harsher. The best solution is not fear, it is preparation. Learn the rules, set up proper systems, get ahead of MTD, and use the legal tools available to you to keep your tax bill as low as possible. If this video helped you and you want more guidance on tax savings, MTD compliance, or running a business the smart way, subscribe to the channel. And if you need help preparing for MTD or reducing your tax bill legally, drop us an email. Stay compliant, stay informed, and stay in control of your finances.